Welcome to episode 10 of the Minds Capital podcast, the show devoted to the world of independent sponsorship and deal-by-deal private equity. I'm Will Smith, here with my partners in Minds Capital, Max Lummis and Nicholas James. Today's interview is a fun, if pretty technical one. We get into the deal terms that our guest, Nick Haschka, has created for his roll-up of generator companies. They're unusual terms. We saw them in the wild, actually, in another deal. So we know that they've resonated with other sponsors, but we also recognize that they're going to raise some eyebrows. So like yours, perhaps, Max, you want to pick us up there? How did you react to this structure that we learned about today?
It's different. I mean, this is, Nick is not a traditional independent sponsor. He's someone who comes from the self-funded search world, where the terms are drastically different than independent sponsor deals, and the deals are different as well. So self-funded search deals tend to be a bit smaller. The self-funded searcher's coming in as the CEO, as opposed to an independent sponsor who's coming in as more of an advisor or board member, really. And then oftentimes that independent sponsor is bringing a new CEO, new CFO. So I think the two platforms are different. Self-funded search is different than independent sponsor, and the terms are different, and the opportunities are different in some cases in both spaces. And with the self-funded search world, sometimes there are some low-hanging fruit opportunities based on the business's life cycle that are available that might not be available in an independent sponsor deal. So Nick is coming from that world where terms tend to be very highly favorable towards the sponsor, the searcher. And he's taking a more conservative approach with a lot less leverage or no leverage. And he's offering more favorable terms to the investors than a typical self-funded search deal. But those terms are not necessarily as good as what an investor might get in an independent sponsor deal. Yeah. So it kind of sits in the middle. It's interesting. It's thought-provoking for sure.
Well, it's funny because I feel like I hear myself say that the sponsor world and search world are kind of on a spectrum, and many sponsors or a few sponsors we've talked to started as searchers and graduated into sponsors. This episode, however, this interview made me feel like the worlds are still very segregated because Nick's perspective is totally different. It's very self-funded search. And he's anchored to those terms, and he actually sees the terms that he's offering here as more generous because he's so used to the self-funded style. But coming from sponsor land, they definitely are less generous. So a real kind of bifurcated understanding of terms, I think, in these two worlds. Nicholas, what do you think?
Yeah, I agree with all of those viewpoints. And one thing that I often talk about is that one of the most difficult things for an independent sponsor who's under LOI is the inherent conflict between, on one hand, you're diligencing a deal and you're negotiating with a seller, and you effectively have to tell the seller that I can't pay a single dollar more for this business because it has all of these vulnerabilities and yellow flags. And then on the other hand, you're selling and promoting this deal to investors and saying it's the best deal ever since sliced bread. And you're saying there's so much upside, and this is a conflict. It's actually really hard to manage for any independent sponsor out there. I don't care how experienced they are. Finding the right balance between selling a deal and diligencing a deal, it's hard. So here in this episode, we kind of double click on the latter point, right? How do you sell a deal? And what has to be in place for you to be able to not only sell the deal, but negotiate so favorable terms that you're above market with your investors. And so we do a real deep dive in that. As you said, Will, it's quite a technical episode in that we go point by point into what are the factors that have to be in place. But I really enjoyed it. It ended up being quite a structured list that I found very educational.
Yeah. And I have to just pat you on the back, Nicholas. That was very impressive that you came up with the list of the things that needed to be true on the fly, into our interview, and rattled them back to us while Nick and I took notes on what you had just said.
So the way that came about, as we were interviewing him, I always take notes as we go through these interviews, but towards the end, I was like, wow, this is becoming a long list of factors. And so towards the end of the episode, you'll hear me rattle off what is 12 distinct reasons for how, or 12 factors that may have to be in place if you want to negotiate favorable terms versus your investors.
Yeah. And actually, Nicholas, I'm not sure you mentioned these, and these might not be fall on that list. They might just be other things that differentiate Nick's structure here. But the other thing to just say about it is he's buying smaller businesses than sponsors would, and he's doing a long-term sort of indefinite hold roll up, and he's the entrepreneur operator. So he is full-time in this and will be for the duration. So some of those might have appeared on your list, some might not have been. Those might have just might be kind of more terms of the deal or structure of this whole project. But it's another thing to just call out here. This is really kind of a sponsor, self-funded, high roll-up, long-term owner-operator hybrid. It really doesn't fit neatly into any category, but a lot to learn from really the debate a little bit that you guys get into on these terms. So I think people will learn a lot from it.
I mean, he seems to have pioneered, like you said, a hybrid new model for funding these types of deals.
Yeah.
So yeah, kudos to him.
And you said there at the very beginning, Will, that we have actually seen these terms in the wild. Yes, we looked at a deal recently. We really liked the deal, loved the sponsor, decided in the end that the terms were a little expensive for us. But so that's exactly what you're talking about, right?
Right, exactly.
The example of seeing Nick Haschka's deal terms in the independent sponsor world. And I'm pretty sure he oversubscribed that deal in the end and made it happen. So good for him. That sponsor we talked to.
Right. So all the skeptical listeners know that this isn't the only case of somebody getting these terms, actually. Well, let's get to it. Here is Nick Haschka of On Point Generators. Welcome to Meeting of the Minds, your connection to the growing world of independent sponsors and deal-by-deal private equity. We are your hosts, Will Smith and Nicholas James. Nick Haschka, welcome to Meeting of the Minds.
Great to be here. Thanks for having me.
Nick, you and I have sat across from each other like this a number of times. You've been on my other podcast, Acquiring Minds, over the years to discuss your adventures and successes in self-funded search. But today you're doing something more akin to independent sponsorship. And one of the key features of your now venture is the GP economics that you were able to secure, which are solidly above market from what we typically see in independent sponsor land. We're going to spend a lot of time there. We know of at least one other independent sponsor who's copied this structure of yours into their own deal and raise. But Nick, let's begin with a little bit of your history as a searcher, which will really inform what you're up to today.
Yeah. So I started my first search in 2016 with a partner after a failed Silicon Valley venture-funded startup, and quickly was able to come up with a small business to acquire. That was called The Right Gardener, and ran that business for a few years, grew it pretty substantially, mostly through add-ons. And it was an office plant company in San Francisco and retiring owner, and a very common pattern for what people look for in the self-funded search world. A couple million in sales, in the mid, hundred thousands of sellers' discretionary earnings. And we were able to have some pretty significant success growing that business and stabilizing it and professionalizing it. After a few years, I left that to, my partner came in and he wanted to take over the day-to-day. And I decided to start moving on, looking for what was next. We did another acquisition in the landscaping space. And I built that for 2 years. And we sold it after kind of deciding strategically it wasn't where we wanted to be, to a private equity backed roll up. And then that freed me up yet again to go out and search and think about what I want to do next. And that's kind of where I landed and where I am now, which is pursuing acquisitions in the backup generator space. And we bought our first acquisition last year, I guess in 2024 at the beginning of the year, after spending most of 2023 in search and fundraising mode, and then bought our second one in midway through the year, and are continuing to look for targets, but right now going through a bit of a digestion and kind of operations period of figuring out what it is all that we bought, and trying to get the company professionalized, modernized, and on kind of firmer footing for strong organic growth going forward.
Awesome. That was a great recap, Nick. Thank you. Tell us a little bit more about this backup generator roll-up. Fair to call it a consolidation play, essentially?
Yeah. So with that, we had hypothesis that there was going to be opportunity in the trades, and specifically in this backup generator space, a lot of macro factors driving a bright outlook for the backup generator space, both on the residential side as well as the commercial and industrial side. And there was, historically, this has not been a big business, and those that do it are generally fairly small. And the belief would be that there would be both consolidation and significant growth to come in the out years, call it through the 2020s and probably into the 2030s. And with the challenges we're facing with grid integration and climate change adaptation, end of life issues with the utilities, we felt like that would be a good place to put a stake in the ground and try to build a successful business in that segment.
And where you're based is also key to the thesis.
Yeah, so we're based in California, which has been a bit behind most of the rest of the country in terms of experiencing significant outages that drive demand for backup power. That's really been pretty obvious just in the last 2 years since we've been operating a generator companies. But the outages here just continue to get more and more severe, and that gets more and more people, both residences and business people, spending more time thinking about what their emergency power system needs to look like and how they need to adapt their power infrastructure to meet the needs of their mission critical operations, or their whatever their needs for their day-to-day life is. Great.
Thank you, Nick. Now, one of the things that you'd said to us when in those years when you were deciding, I guess after selling the landscaping business, deciding what was next and arriving at this thesis, you were also spending literally years, you said to us, thinking about what the right structure for this would be.
Yep.
I guess, of course, we'll want to basically hear about it, but as just a little bit more context, what were you trying to solve for in the structure? Why did it take you years to arrive at a structure that you thought aligned incentives appropriately?
Yeah. So as a searcher, we acquired our own deal with our own cash, and we didn't have any outside investment. Once we started developing some success and then networking our way through the industry, through the kind of the search world, we started seeing deal flow and opportunities to invest in the self-funded search world. And I got pretty well networked in there and got to know a lot of the people who are active in that space, and got comfortable with the structure. While at the same time, as an investor, looking at these deals and scrutinizing these deals, I just had a lot of heartburn over the idea that a searcher would land with basically put in 0% of the cash and own 80% of the common equity after returning the capital. Granted, there's a preferred or a hurdle rate in there, but the idea that you could, put in no cash and own 80% of the business, to me, just didn't strike me as quite right. And it was pretty much inverted from traditional private equity independent sponsor, which instead of owning 80%, you own 20% through your carry. And we wanted to do something that I think we would be comfortable as an investor participating in. And we didn't want to give up what I think are incredibly favorable economics that you get as a self-funded searcher, but do something that we felt would better align both the interests of the searcher and the investor, as well as give the investor quite a bit more upside associated with participating in the venture. And then the other thing that we could talk about the details of the model, but these search deals were very, very highly levered, and the searcher is taking out a personal guarantee. And we were kind of at myself and Anu, and we were kind of out of a point in our search careers where we didn't feel like it was smart to be making that kind of bet, because there's too much to lose at that point, and you don't want to bet the whole house on just the next play, because if you bet the whole house enough times, like eventually you lose. And so we wanted to do something with less leverage, less kind of fundamental full risk of full loss, and grow into our debt rather than taking all the debt at the outside and hoping that everything goes okay.
There is a contrast between the economics, as you point out, that you see among independent sponsors that are more in the range of private equity. There's a management fee, closing fee, and carry that hovers around 20%. And then self-funded searchers that tend to be much, much higher, as you said. What is it that makes self-funded searchers able to command much higher pricing, do you think?
Well, I think in some sense they're trading the search period. So they self-funded the search period. So there was all of that cost kind of rolls into the deal as searcher equity. So there's a fair amount of sweat equity component that gets awarded as some share of that 80%. Most searchers aren't taking a lot in like deal fees, or really all their economics is just rolled into this slug of 80% common equity. And 80%, it's not always 80%. A lot of times, especially now, it's kind of coming. I think it's coming down a little bit, but they're basically foregoing, say, 2 years of working and getting paid, and they're foregoing deal fees, they're foregoing management fees. They're basically foregoing kind of all forms of economics and just betting on that common equity. And I think that's how they are able to. And then in addition, they're bringing a personal balance sheet, a family balance sheet, and a guarantee. And I have a hard time with the idea that guarantee is. It oftentimes gets priced as dollar for dollar, like the guarantee as if it's equity. I have a hard time with that idea, because I don't think a guarantee of $1 is equivalent to putting $1 into the deal in cash. But in some sense, that's kind of how the math ends up working out.
Say more about that. What do you mean dollar for dollar? How they're thinking about it?
Yeah. So like in a self-funded search deal, if only 10% of the total transaction is cash, is cash equity, and then 90% of the transaction is debt, the searcher's really getting credit for that debt that they put on the business as if they had put in cash, and discounted somewhat. But in reality, the cash flow of that business is going to pay back that debt, not them. Right? So it's not like they've borrowed money. It would be different, right? If they had borrowed the money and then funded it along with the equity investors and told the equity investors, this is an all equity deal, no debt.
In that scenario, right, it's like you take an LBO and the searcher is taking the entire advantage of the L, which is what uses equity returns.
Yeah.
But an investor wouldn't care about the 2 years that happen before the deal closes. For them, it's an investment, and whether the searcher spent 3 months or 3 years doesn't matter to them. For them, they're looking at the opportunity at hand. They're not trying to back pay a person. They can invest in a sponsor. They can invest in a searcher. What is it about a searcher's deal that enables them to charge a higher price compared to independent sponsors? And maybe to set the table here, and I can kind of go through it, this very standard, uncontroversial independent sponsor terms. There are 3 pillars, according to the McGuire-Wood study. The first pillar is a closing fee, typically 1% to 2% of the enterprise value, most commonly rolled into the deal as equity. The second pillar is management fee, typically 5% of EBITDA as an annual fee, with a floor and a ceiling, a floor typically around $200,000 or $250,000. And then lastly, a carry, where I think the standard would be 20% over a 8% hurdle. But more often than not, you'll see, a little bit of a more complicated version of that, but give or take in that range. So that's kind of what the basis is from our perspective, working with a lot of sponsors. But your frame of reference was the self-funded world, where a few years ago, if you go back to 2021, when capital was very cheap, you would see searchers take as much as 80, 85, even up towards 90% effectively in carry. That's come down, as far as I can see, down to call it 70, 75%. If you think about that from an investor perspective, you've gone from, if a searcher goes from 85% carry to 70% carry, it's not that big of a haircut for them, but for an investor, they've gone from 15 to 30% ownership. So it's actually a 2x from the other side of the equation. So it's quite impactful. But even at 70%, this is 3 times higher than what independent sponsors are charging. And most sponsors are, just to generalize, a little bit more experienced in the deal world, a few years older. Their deals are bigger. So isn't it, almost like a paradox that a first-time searcher can charge so much more?
Well, I think there's a challenge here with the scaling economics of these deals. Just the scale is very different, right? So when you're talking about a $1 million deal versus a $10 million deal versus a $100 million deal, in the $100 million deal, the searchers, like in the self-funded search world, like their salary, kind of rounding error, right? They're probably going to take 150K salary. In the $10 million deal, starts to be more meaningful. In the $1 million deal, their salary is very meaningful. And so I think the model, it's hard, you're just talking about kind of different denominations and then really orders of magnitude and difference of total deal size, total cash flow available for distribution, how the cash gets split out. And I think why you see that is because you're talking like the total dollars in play for how it's going to get divided up between operator, searcher, investor, and then even the different flavors of investor, the preferred versus the sponsor or the common. I think that puts makes it hard to compare even when you're dealing in percentages without referencing, well, how big of a deal are we talking about here? Right? Because percentages, while they're nice because they normalize and allow you to compare, I think most self-funded searchers arguing with independent sponsors over, well, why are the economics so wildly different? It's because the denomination and kind of the order of magnitude tends to be just fundamentally different. And the compensation package of the sponsor is dealing with sums of money that are meaningfully high relative to the total deal.
I also think it's probably a different investor. So the investor in search funded deals they've been anchored to these terms because they probably come from self-funded search land. Whereas on the independent sponsor side, it's going to be different capital that are used to different terms. So there's a little bit of a knowledge siloing, I think, that happens.
Yeah, I think there's some of that. And I mean, I don't know a ton about this world, but my understanding is that there's a little bit of this in the real estate world too. When you're talking about real estate private equity, all the way down to small time flipper, those arrangements look pretty different. And what the economics look like for the small time flipper probably has that similar kind of disparate or almost inverted division of profits from the more institutional real estate private equity. And I think there's probably a comparison to be drawn there that might shed some light.
And another factor, of course, at play is valuation, right?
Yes.
So can you run through the math? Like why does that matter?
Yeah. So in the self-funded search world, especially in the small deal world, in the SBA kind of call it single sponsor, one entrepreneur who's looking to buy a business of a few $1 million and is going to pull down an SBA loan and guarantee it and put his house on the line. He's probably buying a business that's three times cash flow, maybe 4 times cash flow in the transaction price. And in the private equity independent sponsor world, those numbers kind of start to go up because you're talking about, what they believe to be a more de-risked business, a more professional enterprise. That person's contribution relative to the contribution of everybody else that makes that company generate that cash flow is going to be quite small, especially at the beginning, versus the entrepreneur who's stepping into a business with 10 people, like they're 10% of the labor. And they have a very, very meaningful impact on the trajectory and the possibility for that business because just even if you just add up the labor hours and treat all the labor hours equally, like that entrepreneur is a very meaningful contributor to that cash flow that they just bought. Versus when you're exiting a seller in an independent sponsor or private equity deal, they will pretty much need to assess that person to be kind of non-critical, non-key, and that really changes the risk profile.
And then, of course, from the investor's perspective, if a deal is 3.5x versus call it 6 times, the amount of equity you need to raise is, as a total in an absolute terms is also very different, right? For a 3.5x deal, you might get away with raising maybe just half a turn of equity, in actual cash equity, right? Half a turn of EBITDA in cash equity versus a 6x deal. You're probably looking at 2 or 3 times of EBITDA that you have to raise in equity. And so effectively you are diluting it because it's more expensive, right?
That's right.
So yes, the terms to the GP terms are cheaper for a sponsor, but the deal terms are much more expensive because you're paying 6x for the deal instead of 3x. And so the reverse engineering to get back to a base case of 35% IRR is much harder to accomplish when you have to raise a lot more equity versus if you only need a tiny sliver of equity, you just need to pay it back and pay off some debt. And much like when you buy a house, right? You buy a house for $1 million, lever it up 80%. That grows to 1.2 or 1.4. You've doubled or tripled your equity versus if you only put 500K of debt on that, right? Then your equity has grown from 500 to 700K. So it's not a 2x, but more like a 40% increase.
Yeah.
So how does this marry into the Nick Haschka innovative deal term concept? You married the two worlds. You saw that it worked on a small kind of deal basis as a self-funded searcher. And then you evolved to become an independent sponsor. And you said, what can I borrow from the self-funded terms, because these are attractive for me as a GP who does all the sweat equity. And it's a replicable model, and it's so replicable, in fact, that other sponsors are now emulating it as well. We looked at a deal from a very smart guy out of Connecticut called Dino Savaya. And so the word is spreading about what you're doing, and we'd love to hear about it.
Yeah. And one other important context here the audience will understand, but just to put a point on it, one of the ways you're not a traditional independent sponsor, Nick, is that you're operationally, you're like a self-funded searcher. You are very in the business. Just before we hit record, you were telling us how your day started at 6 a.m. this morning, because that's when the trucks roll out. So you are really running this business in a self-funded searcher style, as a contrast to independent sponsor land, where that's very rare. Yeah.
So this is, first and foremost, an entrepreneurial venture. We have a business that we aspire to build in the backup generator space. Our fundamental, kind of starting building blocks, were going to be acquisitions. And we have both an organic and inorganic growth strategy. But those first few building blocks upon which kind of the initial business plan was priced and offered to investors were these 2 small acquisitions that were purchased kind of in the range of 3 to 4 times free cash flow, with a sort of open-ended. We didn't have the debt terms totally nailed down. The first deal, we raised enough equity so that we could do the first deal in all cash and get started, and then brought in some debt for the second deal. So our plan was to bring in a more significant slug of debt, call it like 18 months to 24 months down the road. What we ended up doing was getting a bunch of that debt from a favorable seller note for our second acquisition. And so we were able to lever up a little bit sooner, lever up more a little bit sooner than we had originally intended, but not with bank debt, with seller financing. And then leave ourselves in a position, both cash-wise and operationally, if things go to plan, to be able to go and do more of these kind of 2-3x type of add-on acquisitions. And by the time you combine these first two entities, which were very much the types of entities that a self-funded searcher would go after, call it, a couple million in sales and under $1 million in SDE, or around that. And so we put these two together and are, trying to build that into a platform company, that can then go and continue doing acquisitions and acquiring in other businesses that look, of similar size and scope. By which point, each time we do that, each of those will represent a kind of a smaller portion of the then current total, total business operation. And so, we raised a bunch of money up front against that business plan. And the structure of that was deliberated. It started with kind of the convertible preferred 80-20 kind of idea, but trying to solve for like things that I didn't think as an investor were really, really fair about that, because of the tweaks on the self-funded model that we made.
So the convertible preferred, well, what exactly did that look like? So it's a debt instrument. So all the money you raise from investors is actually debt up front. You would then pay them some kind of coupon.
Yeah, typically like an 8% coupon.
Okay.
I'd say what was customary at the time was like an 8% coupon, maybe like 8 to 10% coupon, and then converting to, call it 20% of the common equity.
And did you have any senior debt on top of that, or was that the most senior layer?
There would be, in that structure, there's always, usually like, 2 to 3 turns of senior.
Okay, yeah.
And then maybe 10% seller note of some kind, and then equity filling in the rest.
Right. Okay. So you raised, but that did not work out, I think you said, right? So
we didn't even pursue it. I mean, that was sort of our understanding of the self-funded search middle of the fairway deal. What we were doing just didn't apply to that. And it didn't apply to that because we weren't putting the big senior debt up front. Instead, the plan was to go out and get that senior debt later and lever up 12 to 24 months later. And so the investor doesn't have the certainty of that leverage being there and that financial engineering being there. So in exchange for that, we raised the coupon rate a little bit. And then we introduced a waterfall. And so the waterfall distribution basically says, just like in these convertible terms, we kind of put a floor on the returns, but instead of 8% or 9% or 10%, we put it to 11%. So gave a little bit higher floor. We also put in place the first tier of the waterfall, actually similar to how most of these deals work. We take a 40% carry, or 40% of 100% of the profits go to the investors until all profits and all preferred is returned. So that sets kind of return of capital plus a nice 11% hurdle rate as kind of the floor for investors. And that preferred coupon, we're not obligated to distribute, because if we think there's a better capital allocation to grow the business and pursue the business plan and do add-ons, then, especially when you're buying at 3 or 4 times, like that's going to be a much, better use of capital. So we gave ourselves the flexibility and not the obligation to distribute free cash flow, but rather to make that capital allocation decision. But in the event that we chose to distribute cash flow, investors get every dollar first toward their preferred, next toward their principal, until they've been repaid the entirety of that basically pool of capital. Then once all of that has been achieved, it goes to 60-40, where the investors are taking, for every $10 distributed, investors take 6, sponsor takes 4. And we repeat that until the investors get to 3 times their money back cumulatively. And so that puts a nice, the investors getting a pretty nice stream of cash flow there. And that's kind of the next level of quote success of the venture, is if we can get them to 3x their capital back. And once we get there, then there's this next pool, which is it flips from 60-40 to 40-60. After you've already gotten 3 times your money back, Mr. Investor, if I'm going to keep distributing cash, you get $4 out of every 10 distributed, and we'll take 6 to the sponsor.
Is there any catch up here at each level? Like, would you catch all the way up to 60%, or is it only after that stage?
Think of it as a total pool that has to be full until you can get to the next stage.
Right. But once you've hit 3x, do you catch up and give to yourself until you get to 60%, or is it just like now you're in a new pool, so to speak? And
that's right.
Yeah. Okay.
Yeah.
So
no
each
catch
pool
up.
has flows to the sponsor and flows to the investor. It just
because
so
most sponsors will have catch ups, but you actually don't have that. And
yeah,
instead
no catch-ups.
You just have a slightly more or meaningfully more aggressive kind of shares. But okay. So continue.
So then the next pool, so it goes investors 100% until they've gotten all their money in the preferred. Then they get 60% until they've gotten to 3x. Then they get 40% until they've gotten to 5x. And then after 5x, investors get 20% of distributions thereafter.
And so, Nick, what is it about the standard terms, call it 20% carry, that aren't good enough for you as a GP? Why wouldn't you be happy with that and say, I'm doing a lot of deals? That's a good win for me if it goes well. Why would people push the envelope like you have done?
We could have pursued a deal where we would have bought the whole thing ourselves and not involved anybody. We instead put ourselves in a position where we thought we could build something substantially bigger by taking a bit of outside money. And we wanted to construct an investment vehicle that we felt was fair to us as the sponsor and fair to us and everybody else as an LP. And so that's kind of where we landed. We kind of priced out I just don't think in this like small world, we're talking about a few $1 million, the 20% carry is, it would give us a reason to like get out of that and go use and basically keep investors out of the next one, versus under this structure, our incentive is to get cash to investors to get their IRR floor higher and higher and higher as the venture progresses, while at the same time meaningfully motivating us to keep going with this thing and make it big.
But you're saying effectively that we didn't really need investors, but hey, if you guys want to come in at these terms, you're welcome to.
We would have done a different business plan, somewhat different business plan, if we could have, yes, for sure. It would have changed how we pursued it, and it would have changed how we structured it. It would have changed a bunch of things about the venture. The way the venture is designed, the cap table and the fundraise and the risk allocation and the capital allocation and the cash flow allocation all really hangs together.
So let's go back to the contrast to the general terms, because you have a much higher carry structure, but you're not charging a closing fee. You're not charging a management fee. You're taking a salary for being in the business, but it's not a monitoring fee, so to speak, as an independent sponsor typically would have as a management fee. And your carry only kicks in after an 11% hurdle as the first tranche. Mm-hmm. So you are kind of foregoing some terms there, but in exchange, you're getting a lot more of the upside. And so from your vantage points, obviously, if it goes well, that's fantastic. If you do multiple bets like this, chances are at least one of them will do really well, right? And if you have one win, And it doesn't have to be, a 10x situation. It can be a 5x situation. You're going to be very handsomely rewarded if you could have one of those inside of your portfolio.
But this is the only thing you'll be doing, Nick. You're not building a portfolio. But I don't think, Nicholas, you mean other acquisitions within the generator business, because the generator business is all you're going to be doing, Nick, from here on out, right? I mean, until you build an exit 10 years from now.
Yeah, and ideally, it's a business that it's structured in such a way, it's run in such a way that I would never want to exit.
Mm-hmm.
And I think I have the structure in place where that if we do it that way and we're successful and we get above that 5x MOIC hurdle, even if we get above the 3x MOIC hurdle, everybody should be very happy, right? Because the returns on that look spectacular, kind of almost timing independent. If it takes us obviously the returns they are sensitive to time, but at the end of the day, most investors care more about dollars, and these MOIC hurdles protect them to ensure that the dollars that they get out of the venture, if the venture goes according to plan or better than plan or even significantly worse than plan, they're kind of protected.
Mm-hmm.
Dino copied your model without being in the business. He's more conventional sponsor in the sense that he will sit on top of the business. And so that is not a requirement, right? But what has to be, you're charging more than average. And in order to charge more than average for anything here in life, right, we have to deliver value somehow that is more than average also. And so we talked about valuation. If you have a very low entry point, that could be one such aspect. In your case, you're also arguing that your very hands-on approach and that this is your full-time sole focus is a value add. But what else has to be true for an independent sponsor to consider chasing above market terms?
I mean, I think track record goes into it. The fact that we've done stuff that looks successfully done stuff that looks a heck of a lot like this. Business size, industry experience, like insights that, so we definitely brought a lot of priors. I think the composition of the team provided a lot of risk, kind of downside risk mitigation, and just the structure in and of itself provides a lot of downside risk mitigation for the investors. And then basically the assurance and guarantee that I'm going to be there slugging it out through good weeks, bad weeks, good days, bad days, to try to deliver on the plan. And we're also the largest equity investors, so we put
you are personally, you mean, and that's
myself and
skin in the
Anu
game
together, yeah.
But you have a where some sponsors will happily take on more equity because it gives them a better balance sheet. It gives them more dry powder to grow with. In your case, or in anyone who is chasing above market terms, there's a direct conflict between over-equitizing and getting higher or better terms, right? In fact, you would want to have as little equity as possible and maximize leverage. How do you manage that?
On the MOIC number, I mean, really we're striving for the multiples, not the timing. And so we wouldn't want to we definitely wouldn't want to maximize leverage. We don't want to put ourselves in a position in that kind of position to lose the equity.
Right. But so yes, you can have a lower valuation if you want. But if we go back to the house example, that was maybe not 100% the apples to apples that we had here earlier. The more debt you put on a business, the easier it's going to get a good MOIC. And if you can present a base case with low growth rate, same exit multiple, it's easier to believe in it, right? Yep. And if it's easier to believe in it, it's then going to be easier for you to get away with better terms. So there is a conflict between trying to negotiate for better terms versus doing an all equity deal, for instance.
I guess my thought was going into the business. So I don't see the capital structure as fixed. The capital structure is something we are going to manage actively. And so I think that's part of the bet that our investors came along with, is that like we are going to thoughtfully manage the capital structure and be assessing risk all along the way. You're not signing, you're signing up for a capital structure on the day that you send the funds, but that capital structure, I promised, is going to change. And depending on where we are and how comfortable we are with the free cash flow performance of the business, the asset base of the business, what opportunities sit in front of us, we're going to be reassessing that capital structure all along the way. And some of what is you're putting faith in me as an operator to be honestly evaluating that and trying to deliver good returns to equity, while at the same time being a good steward of the business and the capital. And so I think there's a trust aspect of that. And I think the alignment of the skin in the game is like, yeah, we put a bunch of money into this thing. In fact, more than anybody else. And we want to see a return on that capital too. And I would be stupid not to be constantly looking at that capital structure and figuring out what I think my debt position can be today, given the risks, given the business as I know it and the risks that I have. And so we should be adding leverage to the business as we gain operational footing, as we gain confidence in our ability to forecast next year. And as we know what our opportunities ahead of us are going to look like.
Nick, I think a big part of where you arrived at on terms too, I mean, you said it, but just to call it out, is like you were anchored to self-funded search terms as opposed to coming from independent sponsor private equity land and being anchored to those terms. So you really started at those extreme terms and moved more toward private equity as opposed to the other way around. We're coming at it from, traditional independent sponsor terms. This seems aggressive, but in your own words, you said, actually, we weren't going to do self-funded search terms, which don't appeal, which as we thought about the investors didn't seem that appealing. We wanted to, so you were actually trying to make something more appealing to investors. And even though it sounds like we're pushing on you these are such aggressive terms from the perspective of investors, but it's because you were anchored to self-funded search terms where investors have 10, 20, 30% of the common.
Yeah. And I think we've also inverted the capital structure, right? And so if you think of the capital structure not as a fixed, like you can do the math of debt and like just in its simplest, debt and equity on the day the deal closes. But really, you have to look at the life of the venture. In a self-funded search, they're thinking of the capital structure as 10% equity, 90% debt, and then that 90% basically drops to zero over 10 years. And then it's all equity at the end. In our structure, it was all equity, and then the debt is going to go up. And again, this is looking at it in terms of percentages. If you look at it in terms of nominal dollars, as you grow the business and the composition of the capital structure, and you don't do the percentage normalization, it looks even more different. So our view is that our structure, as the business grows, and you play out the way the capital table or the cap structure looks over a series of years, the percentages change and the dollars change, and our pools are protective of the investor to make sure that early on, especially while we're riskiest, they get the most, and it's very, very favorable to them. And then later on, our reward is is more out here, both in percentages and dollars. And then if you model out the returns through different scenarios, the investor's return, even in the home run case, it's still fairly, especially if you're doing it in kind of percentage IRR, it's still fairly sensitive in the out years in various success cases. And it's not, even though, because the waterfall concept, it's all marginal, right? It's like, it's all marginal to what has happened cumulatively before that. And so the amount that last dollar that tips you over 5x, yeah, I'm taking 20 cents of it, but it doesn't meaningfully impact your return that you only got 20 additional cents on that last dollar after 5x because you got 5x.
But as someone who's putting together a portfolio of deals in the lower middle market, if I want my portfolio to land at 3 to 4x MOIC, I know there are going to be a few losers in there, or some that are below that range, some that may even be 0. I don't know which, but realistically speaking, there is a failure rate. And so in order to offset that, I'm going to need some deals that are 4 or 5x, but I would love to have one that is 8 to 10x as well in there. And you've all but taken away that possibility for your investors to get to 10x because you take 80% over 5x.
I don't think it works out that way, because as you grow the business, the 80-20 is just the profit split. And by the time you're big, 20% could easily be returning all of your capital. So I don't think I don't think it works out that way, because just if the business progresses and grows and compounds, even a 20% split on a business that's way, way bigger than what we started at, that may return you could be returning 1x of what you initially put in kind of every single year after you're already in that 5x tranche. So I don't think, and we think of this as long-term, and we wanted to give ourselves an incentive to do the long-term, and we wanted to motivate us, we wanted to motivate MOIC and not IRR percentage. Because I could deliver a really good IRR on one of these, little fix and flip type of deals. But I didn't want to be incentivized to fix a little business doing, $1 million in SDE, buy it for $3 million and sell it for, $6 million in 2 years. Like, that's a spectacular IRR, especially if you lever it. But nobody really made that much money.
I agree. I think IRR is relevant in comparing the asset class as a whole to other asset classes, but it's not as useful as MOIC when you look at any particular case study, because the time length is so variable, right? As you say, some deals exit in 2 or 3 years. Some deals are held indefinitely or sell after 7 or 8 years. And the IRR is very much at the mercy of the timing, where MOIC will never be. And so you base your hurdles, except for the first one, I guess, based on MOIC, right?
All in MOIC, yeah.
And Nick, so you started with 2 businesses that are roughly $1 million in earnings a piece.
Mm-hmm.
And how in the out years, how big could this get? What were some of the numbers on revenue and earnings that you projected?
Yeah, so I think in the next several years, this could it could be quite big. It just kind of depends on, I don't think that far ahead, but, we put out a model of what we thought this could look like, and then modeled out a pretty wide ranging set of scenarios. And
it's sort of 10 to 20 in EBITDA sort of thing.
Yeah, but nowhere in there, for the modeling case, yeah, we put an exit in there, but I think practically speaking, we want to build a business that we don't want to sell. And then everybody's just happy with the cash flow. So there's not, at least the way I think about it is, the waterfall, if the business is cash flowing, then we want to get to a point where it can distribute cash flow and grow at the same time.
Mm-hmm.
And every time you get, as an investor, you get $1, it's adding it to your, it's driving up that MOIC number. And every year we don't sell and the business grows, you should be happy.
And I suppose your investors would be implicitly more open to longer term holds, because your incentive is to pay them back fast, get the pref out of the way of 11%, maybe get them up to a 3x if you can do a dividend recap or something like that. Because after that, they only get 40% of proceeds anyway. Right. And so why not just hold, as opposed to in different models where they get the majority at an exit. So it gets pretty tempting in hot M&A markets, right?
Right.
Nick, and your investors, where did they come from? Can you generalize? Or were they from Searchland? Is it institutional? Who? Maybe that'll also shed some light on how you pulled this off.
It's small, mostly small-time investors, a lot of newer investors, people who are interested in the search space, call them search curious, people who wanted to who kind of wanted to ride along to see what we do and how we do it, who maybe have been investing a bit in the space, people who are along, I guess, somewhat for the journey, for the network. I feel like we've been very transparent. We've been very communicative. So there are a good number of people who are along to kind of just learn and see up close. And it's not like family offices or private equity funds or pensions or any, and there's really no institutional composition of, nor did I try to do that. And most of those guys wouldn't invest in something that's this far off the beaten path anyway.
And so you didn't, the stress testing we're doing on your terms here, you probably didn't experience much or at all in your race?
I mean, a number of these folks came from or have worked at institutional investors before. And I think what they realize is this asset and this offering is just very, very different from the world that they came from. And it looks more like the world that they're looking to learn and become a part of. And so I think we benefited from that. And there were certainly people who had heartburn over the quote, the bottom of the waterfall, the high marginal tax rate, if you will. But I mean, most of the people looked at them when you actually look the model and play through the numbers and play through the scenarios. I think what we constructed is pretty good for both.
How does the heartburn there express itself?
Very quick nose.
or do they ghost you maybe? Or, I'm just curious, what exactly do they say?
People look at it as capped upside. And then I had done this in advance, but like I ran the sensitivity tables at the top of the waterfall, and I just don't think it's capped. People have a hard time thinking in percentages, or people like to think in percentages, but they have a hard time translating those percentages to dollars until you play it through the model and look at the dollar numbers.
Yeah,
no,
exactly. It's about framing, right? If you say to anyone that, hey, I have a proposal to you, I have high confidence I can get you to 3x or maybe even 5x in call it half a decade, that's a win if you actually can believe in that for any investor. I don't care which asset class you prefer. That's a really good return. And so the heartburn comes at it's emotional, I guess, right?
Yeah, because they want to compare it to something that they understand and feel to be kind of fair in market. And for the people coming from the institutional world, that like kind of 2 and 20 or what you outlined in terms of the independent sponsor structures, those are market terms. And I don't think they apply here. I think this is just quite different. And B, I think the waterfall structure solves for a lot of the things that you might be concerned about when investing in an entrepreneurial venture like this, i.e. like, what if we exit early, right? If we exit early, the investors get all the economics and we get very little. Because we left a bunch on the table, which was all the out years of the model.
Right. And you didn't have a closing fee and you didn't have a management fee that was very high. Or you just had the salary, which is modest. Now, as we've been talking, the question at the onset of this conversation was, what has to be in place for an independent sponsor to copy your model with above market GP terms? And so I've been taking notes, if you guys will indulge me for a moment here as we've been talking. Came up with 12 or 13 reasons. So let me know if I forget anything. But what has to be in place? A low valuation is probably the biggest driver because you're creating value on the front end that translates directly into a base case projection, right? You mentioned skin in the game, that you guys are investing. You're not only on the ground, but you're investing meaningful cash. In your case you and Anu are the biggest investors. Number 3, you have a track record. You've actually done deals before, had successful exit or ventures. And so you can talk to the credibility there. Number 4, you talk about operational involvement. In your case, you're full-time on the ground. I know in Dino's case, he's not, although he plans to be hands-on, like a sponsor commonly is, of course. We talked about investor type, where in our terminology, you are chasing retail. That is maybe not as stringent as institutional. And so you have more maneuverability when you work with retail. Number 6, we talked about how high leverage can help because you only need a small sliver of equity. Number 7, you said this applies best to smaller deals because the capital raises are smaller, and this enables the retail route, right? If you are raising 2 million, you can get 10, 20 small millionaires next door guys. If you're raising 15, 20 million, that's going to be harder to do when you have 90 days under LOI. You talked about how an asset that has good cash yield, where you can showcase that on a yearly basis, we're going to start paying you back, because most base cases showcase no dividends and exit at 5 years and your entire IRR projected on that one liquidity event. But if you can show that, hey, I can get you to 11% IRR on more or less a current income basis, that will help your case. I think we're on number 9. We talked about how an add-on strategy, as opposed to having a fixed structure with one acquisition when the cap table and balance sheet stays firm throughout the life cycle. If you're doing add-ons once or twice a year, every time is an opportunity to revisit the balance sheet. You talked about the investor relationships, having them already in place, them being strong, right? Having that trust factor, that's helpful, of course. You talked about the economics are backloaded in your case, and we talked about how you're not taking a closing fee, you're not taking a true management fee. You have a high first hurdle, not 8%, but 11%. We talked about how a target with stable revenue and effectively a low downside lends itself better to this, because, hey, what's the worst case that can happen? Well, I'm not going to lose my money at least, right? And that's always easier for an investor to get into, even if the upside isn't that strong. And then lastly, I think you talked about the ability to pay back fast. I guess that goes hand in hand with the front-loaded economics and dividend strategy. But if you can get the money sooner and there's a pathway to that, that helps. Did I miss anything in there, or what else has to be in place for an independent sponsor to copy this model?
I think this psychological point about orienting attention to absolute cash terms in the out years as opposed to percentages is key, because we've spent 10 minutes on that point because we too are used to thinking about percentages, and really surfacing that point sooner in a pitch than later, I think would be important.
Yeah, and in this venture, just in terms of like which almost like what order of magnitude denomination is applicable, really changes a lot through the course of the venture, right? Because like a $1 million business, where like there's the potential here for, especially when you're buying small, you add up a couple of $1 million businesses, and then all of a sudden, and you grow some, and all of a sudden you're talking about a $10 million business. You've kind of 10x'd the denomination, and you've entered an entirely different market in terms of professionalism, like just the size and scale of the business, the risk profile of the business, who the potential suitors are. And then you do that again, which is, we're still talking, because we're starting just so small, you really like blasting through, almost different paradigms for investing and valuation and multiples, and even just when you're trying to compare apples to apples, trying to compare this venture in year 1 versus this venture in year 7, like they're just really, really different businesses.
Nick, did you tell us how much you did raise?
Total a little shy of 7 million.
Okay, a little shy of 7 million, and the minimum check size was 100.
Mm-hmm. That's right.
So you had somewhere between 40 and 70 investors?
Minimum check was 100, but it actually ended up being like 50. So,
okay. So you had 80 or 90 investors?
I think we're at 38.
Okay.
So it's a good number of investors. And it's a lot we had to have a really, really buttoned up we used a lot of Zapier in executing that deal.
Oh, what do you mean? Explain that. How did you use Zapier
deal docs, just running the process for getting versions of every doc out to the investors, feedback cycles, even just like signing and funding, the administration associated with 39 parties coming to the table. We closed in advance, required some trust. We closed the funding in advance of closing the business acquisition. A lot of people try to execute a simultaneous close, and invariably that gets hung up in some. So we just kind of said,
and Nick, you had deal number one. You had deal number one under LOI.
Correct.
When you raised.
Yep.
Okay. So you did. So it was a thesis that people were investing in, but you also did have a target. But okay.
Yeah, I mean, to timeline it out, it's like we started our raise in like early October, I think. We had all the commitments in mid-November. We had an LOI signed by the end of October. And then we brought in all the funding around New Year's. So all the docs got signed just before that. And then we closed on January 10th.
Well, I feel like I deserve a pat on the back now that you heard that context from Nick. As context, Nick, we also used the retail approach with Minds Capital. Our minimum ticket is $100K, or was for Fund 1 anyway. And the average was quite a bit higher, but we ended up with 57 LPs. And I did not use Zapier. I was doing a lot of that admin work manually, but those are great ideas because we are quite eager to continue the retail strategy. It's just incredible. It helps us connect with a lot of investors, many of whom bring us deal flow and references. And so it's pretty cool. And also the world of retail investors is effectively inexhaustible versus institutionals. There are only so many, and also they have more stringent terms, as we have covered elaboratively in this call.
Yep.
Nick, have you had any benefit that you've seen from having retail investors, or I should say so many investors, and that they are retail, subsequent to putting the deal together?
Oh, for sure.
Really?
Oh, yeah.
Yeah?
I mean,
like what?
I've been able to get CEO calls with peer companies, which has been just immensely helpful to help me work through various strategic quandaries that arise through the course of doing what we're doing. Advice, help. I've got some other company or some other investors in the cap table who own or have owned very similar companies. And I've got some investors in the cap table who own similar companies to what we wish we were or what we are going to become. And that's helpful. So yeah, just having and it's fun to have a cheering section while you're playing on the field. I mean, I've never had that before. And so it is a lot more fun to feel like there's a team behind you. People.
Do you think retail is more maintenance or less maintenance than institutional investors?
Probably less. I would think.
Well,
less.
it's more people, but each individual investor is probably less demanding.
Yeah. They're not. People aren't emailing me back and saying, okay, on page 27 of the quarterly, can you break down in column 3 the composition of the OpEx lines? Like, no, we don't get that kind of probing demand.
Right, because a retail investor doesn't answer to anyone else, right? They answer only to themselves. And if they trust you and they have a good gut feeling about what you're doing, that's kind of good enough for them, versus an associate at a PE fund. They answer to someone. They need to stay on top of everything. They need to look smart to their superiors and their LPs. And they have fiduciary duties to stay on top of it too. So,
and I think
Nick, what is your communication cadence and what do you provide to everybody?
Big announcements when they're worth it, and quarterlies with kind of deep dive meetings. They're very transparent. They're very honest. They're very self-critical, and I'm not there to blow smoke, right? Like, this is hard, and I will share the struggles and difficulties that we encountered during the prior quarter, and those meetings, actually having them at all, because I've never been in a venture where I had to report out to investors before, have actually been a bit therapeutic, because the progress is so much when looked at on that longer kind of quarterly timescale, which is funny because the public market people will be like, oh, quarterly, way too often, way too fast. Whereas I look at that, I was like, oh, quarterly, man, we've come a long way in 3 months. Like we're a totally different company than we were 3 months ago. And all 3 months were painful.
But your stock price isn't going to plunge 15% that afternoon because you said one wrong sentence. So there's you have the long-term view. But it's true. I think every now and then, especially in the search world, occasionally in the independent sponsor world, you meet someone who insists on not having a board. Hey, we'll have an advisor. Or, we're going to keep in touch with everyone, but they don't actually have a board. And for me, this is a mistake. I mean, the governance element of having a board, even if they don't provide you with a lot of input, it's a great place to be held accountable and hold yourself accountable and make sure that you have a strategic narrative that you revisit on a quarterly basis.
Well, Nick, in the spirit of self-critical and transparency, now that you're a year, I guess just a year into this, how's the thesis holding up?
Let's see. So the thesis is holding up pretty well. The integration and path to organic growth on kind of the first 2 acquisitions has been more challenging than I expected. And some of it is probably because when you assess these businesses, you're looking at them through mostly a financial lens, and you're kind of looking at it through the same lens the prior owner looked at it. But without acknowledging the fact that you have or will change just about everything. And so the time it takes to replicate performance in the new operating mode has been, longer and more challenging than I anticipated. While at the same time, when looked at on that kind of longer timer scale each quarter, I'm continue to be amazed at looking back and like, man, I can't believe we were focused on that, and now we're focused on this, and just how much things have changed. Market has been very kind to us. Competitive positioning has been, I think, better than expected. So overall, very enthusiastic about the future for us, and that we'll be able to continue to improve and deliver, growing a great business that make customers happy and is something that great employees want to be part of.
Nick Haschka, thank you for tolerating the interrogation. It was great, and we learned a lot, and the audience is really going to learn from this model. So really appreciate you being a good sport and being so transparent about what you came up with here. And congratulations on year 1 in this, and we'll look forward to your updates. If people want to get in touch with you, Nick, or get their hands on the term sheet, or something written down that really describes these terms in detail, how do you like people to reach out?
Twitter. So at Nick Haschka, or X is a good way to get me. And no, thank you guys, and thanks for what you're doing here for the community, for the independent sponsor community too. It's great that you're bringing people together and providing a really great resource to all the practitioners.
Super. Nick Haschka, thank you. Hope you enjoyed that interview. For more like it, subscribe to Meeting Other Minds wherever you listen to podcasts. You can also watch us on YouTube. And check out Minds Capital, where Nicholas and I are partners alongside Max Lummis. Minds Capital invests equity in independent sponsor deals. So if you're a sponsor with a deal under LOI, please visit mindscapital.co to start a conversation. There's also an investor tab on our website with information about partnership opportunities and future fundraises. See you in the next episode.